What's up, everybody? Welcome back to The Contrarian. Today I'll be talking about how the world's largest market is beginning to force the Fed's hand in terms of the Fed not really being able to raise rates much farther despite what they're currently saying. And of course, this very large market I'm talking about is the Treasury market, the US Treasury market, and the fact that bond yields on longer duration bonds are beginning to come down dramatically from where they were just a few months ago. As a result, on the technical side, longer duration bonds are beginning to show somewhat of a breakout in their price action in the last couple of months, and I'll explain why this is very significant. But first we need to backtrack a little bit and just look at how significant the bear market in bonds has been in the last year. And so I think a good place to start for that is to look at the Treasury yield curve. Just where the yield curve was a year ago is very different from where it is now. It's very inverted right now. I'm sure you've all heard that quite frequently, but it's very inverted right now. Inversion on the bond yield curve means that anywhere from the 1 year or 2 year, usually it's comparing the 2 year and the 10 year, but an inversion on the bond yield curve means that shorter duration bonds are yielding more than longer duration bonds. And this would never happen in a healthy market. The reason why it occurs is investors are frightened. They begin to get scared for whatever reason. They think there's a recession. They think there's some sort of systemic risk that's higher than during a normal healthy economy, and so they get out of equities. They get out of more risky, maybe more overvalued assets, and they get into long duration treasury bonds. And so because of that, because of the inverse relationship of bond prices and bond yields, as investors begin to bid up the price of longer duration treasury bonds, the yield of these bonds goes down. And so typically they more buy into the longer duration treasury bonds instead of the shorter duration treasury bonds. And so that's how you eventually get to this situation of longer duration bonds yielding less than shorter duration bonds. And when I say investors, I'm not talking about your typical investor like me who's just trading in their personal investment account or whatever. It's broadly speaking institutional investors, pension funds, hedge funds, much larger volume of trading occurring. So it's not on the smaller retail type trader side that's doing this. It's more looking at what would conventionally be called the smart money that buys into longer duration treasury bonds when they begin to see recessionary risk out there. And so bond yield curve has become very inverted right now. It's remarkable just looking at where it was a year ago in January 2022, how it was looking a lot more normal. You go from a lower yielding shorter duration bond to higher yielding longer duration bonds. That's typically what you normally see, but right now it looks like the 1 year is the highest yielding bond out there, much higher than the 20 or 30 years. So yes, the bond yield curve is very inverted right now. Looking at this historic Treasury yield curve spread, it looks like we have to go back to sometime in the early 1980s to get to where the bond yield curve was this inverted. It's actually looking like it's more inverted than prior to the Great Financial Crisis or the dot-com bubble burst. So that's very telling that where we are right now, if the bond yield curve continues to be correct in terms of predicting recessions that it has been very correct in predicting in the past, if that holds true, then the current recession that we're either currently entering or going to enter very soon is probably not going to be very pleasant. But now looking at the rally that longer duration bonds have seen recently, on the technical side, looking at TLT, which is an ETF which tracks the 20-year Treasury bond, this chart looks like it bottomed around November of last year, had kind of a double bottom there, and then a run up to around 110 in just late last year. And then it corrected a bit back down to just around 100, and now it's rallied back off of that level. And this would be a great indication if TLT were to break 110 again and then keep going beyond that, because it would show that effectively what investors are seeing is what they're actually doing in the bond in the markets in terms of buying into bonds as a safer haven asset, because bonds typically perform better than most other assets during a recession. You typically see more heavy positions in cash as well as treasury bonds during a recession, and definitely trimming out of equity type positions is what institutions do. But it's very telling looking at TLT and just the technical side of TLT that if this bond ETF breaks 110, continues going higher from there, it could be an indication that we're out of this kind of cyclical bear market in bonds that we saw in the last year, which was very, pretty significant. Bonds had a pretty sizable sell-off in the last year, 2022. TLT went down from 150 it was at just the beginning of 2022 down to around 90 was its low. So that's very significant in terms of bonds. They definitely don't see the volatility that stocks normally do. So it was a very significant sell-off that bonds had last year. And if you'll also look at TLT and during past recessions, typically you do see actually a rally in bonds as investors pile into bonds, as bond prices get bid up, as bond yields go down, and also as the Fed typically does during recessions of cutting rates and stimulating the economy, etc. So all of this is kind of building towards an eventual Fed pivot. My point simply being that this is beginning to indicate that the bond market kind of already has pivoted in a way. It's more anticipating a recession. It's definitely more forward-looking than what the Fed is looking at. The Fed is primarily just looking at lagging indicators, which is not a good way to be acting proactively in terms of where things currently are. The Fed's more looking in the rearview mirror at where things were a few months ago. So all of this being said, this is just a good indicator for where the Fed is likely going to go in the near-term future when economic data continues to come in negatively, as inflation continues to come down for the Fed. That's also going to take pressure off of them. They'll be able to say, hey, inflation's come down. It's not at 2% yet. Maybe it's at 4% in a few months, but inflation's come down dramatically. Housing, consumer spending, all of that has slowed very dramatically from all of the froth that it saw in 2021. So hey, we're gonna back off. We're gonna cut our Fed funds rate. We're gonna begin to not be as negatively impactful on the equity markets as we've really tried to be in the last year. Maybe that's where the Fed will go in the coming months, but all of this is merely indicating that the bond market is almost already reaching that conclusion that it does need to pivot away from a more tightening type of environment. So let me know what you guys think about this in the comments section below. What this could mean, the rally in the longer duration treasury bonds. Is it really an indication that the Fed is going to need to pivot soon? Just let me know what you think down in the comments section below. I hope to see all of you again at some point.